So today we've got a lot to talk about. We've got to talk about Meta, we've got to talk about the economy, we've got to talk about inflation, we've got to talk about the Fed, and we've got to talk about the current stock market crash that's going on out there. It was a ugly week in the markets last week, and this week it's continued. Yesterday was a day that I looked at the markets and I was like, doesn't really seem to be, it should be down. We've had some pretty good earnings, and today, I actually looked at today and I thought, why are we down today? I don't think we should be down at all today, and obviously there's a big fear taking over in the markets at the moment. If you look at the S&P 500, down 3% this week. It's been a tough week in the S&P 500 or in the last 5 days. You look at the Russell. The Russell is, the S&P looks better than what it is because of the big tech. The big tech have been holding up the S&P for the last couple of years and made it look a lot better when everything else has been crashing and burning. The Russell is a bit more of a true reflection of what's going out there. If you are trying to be an individual stock picker, you're probably not going to be looking at the likes of Google. You might own Google and Microsoft, but you're going to have maybe some position in them, but you're going to have a lot more of your wealth in other places. And the Russell's a bit more of a fair reflection of how it's been. You look at the Russell, for example, and if you go from the start of 2020, it's down. It's down, just gone negative, this year, the Russell. And you're looking at that going, basically over 3.5 years now. We're nearly getting on to 4 years of the stock market doing nothing. And it's not been a normal market. It's been a market which is just up and down, up and down, up and down. And it's really weird because we've seen a time frame where normally financials, what reflects a company's value. You say a company's value goes up when they grow revenue and profit, and you're telling me that from 2020, most of the majority of the holdings in the Russell haven't grown the profit and revenue in the last kind of 3.5 years. There's always this term that's thrown around, like, is this going to be a lost decade for stocks? And outside of maybe the big tech in the S&P 500, you do look at some of the other indexes and you look at like the Russell and you go 3.5 years of nothing. If realistically, if you're an individual stock picker, this is more of a true reflection of what it's been like. It's been ugly. It's been an ugly 3.5 years, and it looks to continue. And even though the Russell is sitting at historical low valuations, it just continues to show more and more pain. Look at the FTSE AIM. From 2020, this is down. This is down 31%. You're looking at that time frame going, so, you're telling me all these companies have, from, 2020 have had declining revenue and declining profits in that time frame. It's absolutely incredible. And, the crazy thing about the Nasdaq now is, really, since this new downturn started from July time, most of it, in my opinion, is caused by the Fed hiking up interest rates too fast that didn't need going up. I feel like if we didn't have the Fed hike up interest rates, the economy would still be doing very well, and also as well that the businesses wouldn't have the concerns, the consumers would not have the concerns, they would still be out spending the money. And if that was the case, or the worries that they're going to stop spending the money in this high interest rate environment, and if that was the case, I think we would be in a very good place. But I think that is the reason why we are seeing the pain at the moment. And you look at the July time, the Nasdaq has now officially entered correction. It's down basically 11% now since July, which shows you how really a tough kind of couple of months it's been in the markets. And I was looking on Twitter the other day. I saw this tweet from Paul Hill, and he said, big 3 days of economic news in the States, and he said 4.5% US GDP growth in Q3 is anticipated. It's almost unreal given what the equity markets are doing. And I thought, that's so true. Actually looking at the data now, the data has come out, and GDP growth came in at 4.9%, 0.4% higher than expected. And I looked at today and I thought, today's going to be a really good day in the market. People are going to look at this and go, the economy is still doing really strong, even better than what's expected. And, I thought we'd see a few people, excited at this time frame. And especially when you look at last year, and last year it was 2.1%. And obviously, you look at the time frame now, it's, 4.9%. That's amazing. That's like higher than what the normal kind of growth is at. And you're like, and the stock market's down today. I was really surprised by that. And you look at that and going, even though the Fed have gone far too high on their interest rate hikes, the economy is still doing quite well out there, considering, you look at Visa's earnings, still looks okay. You look at, GDP growth, it's still coming in okay. There could be concerns maybe 6 months down the line, but it's still not showing signs of cracking at the moment, which is pretty positive. And, you start going to the time frame of like, if it wasn't for the Fed hiking up their interest rates, imagine how good the stock market and the economy would be right now. You know, it's a bit of a shame that they're once again going one too far to the slow to react and a bit too far to the one side again. Also, I thought it was worth pointing out is that obviously the Fed are going to be doing their new. They're going to have a meeting next week for potentially what the interest rate is going to be set at on the 1st of November. At the moment, traders at the moment are actually once again pricing in the Fed to pause, which I was quite surprised by because I thought they would once again go for another hike up. Maybe, and that's back-to-back pauses from the Fed if that happens. So I don't know. We'll see what happens. But I mean, maybe they've started to realise they've gone too far to the other side. But I wouldn't trust them. You look at true inflation once again. Apart from the little pop-up that we had in true inflation, that went back up towards the higher 2% range in August, September. Obviously, we saw oil starting to shoot up. Oil has stopped shooting up. People saying $100 a barrel. I think it's sitting around about 84 now, so it has started downtrending a little bit more. And you can see here that the impact on true inflation that's actually starting to happen. Now we're sitting back at 2.3% realistically. So yeah, interesting things going on out there in the background. That's quite surprising. Meta reported earnings. I actually got the screenshot as you can see. When they reported earnings, and the stock actually went up on their earnings. Was a little bit strange because it only went up to what it was down on the day yesterday. I was like, probably should have gone up more than that when you look at the earnings. And then it actually went down in pre-market. And if I actually refresh it right now, we're down 4. Yes, it's done nearly an 8% swing on its earnings, which is crazy. And once again, I look and go, this is the best earnings I've seen Meta posted for a long time, at least over a year. These earnings are incredible. These are 10 out of 10 earnings. You look at the EPS, beat by 0.76. Normally you're looking at like a beat of like 0.1 or 0.10, maybe 0.2, 0.20. 0.76. This is incredible. This is probably the biggest beat on EPS I have seen for a long time from a big tech company. That's over 10% beat on EPS. That is shockingly good. Shocking good. Revenue, 23% year over year growth. I mean, we've not seen Meta do them sort of growth numbers for a long time. That's incredible. We were thinking Meta's going to grow, 10% going forward. And I mean, it might not be this growth forever, but that's so good. And you beat by 700 million as well. And I mean, the shares were up as well. The users, good growth on the users, 7%, 5%. That's the users on Facebook, even up 3%. And this is the thing is, this is in a weak time frame for advertising. We've seen all the companies kind of getting worried about this high interest rate environment, and they're cutting back spending and cutting back advertising, and they do that in that environment, which is insane. I mean, you look here, what has helped is that the ad impressions delivered increased by 31%, so they are showing more ads, and that's the way they've made the numbers look incredibly good. I've noticed this in particular because when I go through Instagram, it's like every kind of free posts or every free stories you go through, like there's an advert that comes up. So without doubt, it feels like the adverts have increased by 31%. But you look at the average price ad decreased by 6% year over year. So that's the example that the advertising market is weak out there. When you look at the likes of S4 Capital and they're saying, we're seeing weak numbers out there, that's clear. That's what was so impressive with Google's numbers as well the other day. You look at Facebook's numbers, and year over year, the average price actually decreased by 6%, but obviously the impressions that they're showing are up so much that it's covering all that. So with these earnings, it confirmed everything that I've said on the YouTube channel for the last couple of months, really, about the weak advertising market. But, Facebook are doing a good job of managing that whole situation, and they should get credit for this. They should get credit for how good these numbers were. And then you look today, and the stock's down 4%, and it's absolutely crazy. You look at the stock market at the moment, and you're seeing these companies that are bringing out good earnings. At the end of the day, why do you invest in a company for a long term? It's so the revenue and profit goes up in the long term, and you're seeing these companies deliver these profit and revenue growth numbers, and it's not getting shown on the share price. And it's, we saw this in 2022. We saw this in 2022 where there were companies that were bringing out fantastic earnings, and the shares kept going down. And I felt like we were past this. I felt like 2022 was that kind of year where you go, well done for making it through. That was a tough year. Well done for making it through, because that year was brutal. That was a brutal year in the stock market, and so many things got killed, and even the stocks that were bringing out good earnings were going down. How many times did we talk about like InMode that in that time brought out quality earnings, and the share price kept going lower and lower and lower. And it's funny enough now that it's actually brought out bad earnings, how much it's got killed on the share price. You look at likes of HIMS. We talked about HIMS and the amount of times that they were bringing beat after beat after beat after beat, and we've shown it on the channel before. Like the improvement of what they were supposed to do and what they have delivered is they were supposed to be there, but they're up here. And what reflection does it have on the share price? Nothing. And that was 2022, and that was a really tough year in the stock market. And I would 100% say the toughest year I've been in the stock market. I've been through 2018, the whole China situation. I've been through the CV crash, which was a tough kind of 3 or 4 months, but obviously recovered it very quickly. 2022 was awful because it was just down and down and down, and day after day after day, and seeing companies that you own and bring out good earnings and they go down, that was a really frustrating thing. And moving into 2023, we thought we were kind of past this situation, but we're not. We're still there. And it's like, once again, you look at that dead year a dead decade for the stock market. Like, this has been a tough 3 or 4 years in the stock market now that isn't normal. This isn't a normal stock market. This should not happen. We should see share prices moving upwards as earnings and revenue grow, and it's not happened. And that's a really strange thing. You look at Meta right now, and this stock realistically is going to be trading at 20 times earnings, and it's probably putting in its best numbers it has done for many years. You look at the share price. I mean, realistically now, you would argue that the company should start pushing towards its 52 Ks right now, and yet it's down off those earnings. It's absolutely crazy out there. UPS came out some earnings. They went down 5%. They said they're seeing a bit of weakness in the outlook, and obviously that's the higher interest rates, kicking in, and a few people spending maybe a little bit less money. But we've seen this. This is no surprise. When you look at the likes of DS Smith, for example, they've said they've seen slowdown in e-commerce. So, you look at this here and you go, all this kind of slowdown that's kind of going on caused by these higher interest rates, but then you see GDP growth up that much. You're like, imagine if we didn't have these higher interest rates, how good it would be out there at the moment. So it's crazy. I just want to point out a line. Align Technologies are down 24% today. That's a big drop. But if you actually look on their earnings were actually pretty weak. There was a bit of a miss on the EPS. Revenue as well came in with a bit of a miss as well, as you can see here. And it wasn't a major miss, but it was like, oh, that's disappointing. And when you're seeing a stock with, oh, that's disappointing numbers, and then they're getting knocked 24%, and you're seeing companies that come in with good numbers, and even they're getting knocked down like 4%. You're like, so really good earnings knocks you down 4%. If any companies come out with any stinker reports with this sentiment in the market, this is what's going to happen. They're going to get absolutely slaughtered, like 25%. There's going to be some big dips this earnings season, and this is an example. If any companies come out with these, and we saw it with InMode as well, if any companies come below what they're expecting, it's going to be brutal out there, guys. And this is why I'm trying to build a little bit of a cash pile at the moment, because I'm thinking if this is how the market's reacting to these sort of things, there's going to be some brutal dips out there that I'll be buying. Imagine if DraftKings come out and say like, there was a situation where something happened and we're coming below expectations this quarter. Still could be a really good company in the long term, or will be a really good company, and depending on what the situation is, but it could be like a one-off situation. But if they come with a little bit of a miss, imagine how much that stock's going to drop, and with this kind of fear out there at the moment, it's going to be absolutely insane. And I'm looking at something like tonight. Tonight we've got Enphase that's reporting, and I'm watching Enphase big time, and I'm thinking, well, you've seen what Solar Edge have done, you've seen what's happened with Inline. I would be very worried about a higher interest rate environment, sensitive company in this environment. If they come out with a miss tonight, I won't be surprised to see this stock absolutely get slaughtered tonight. We'll see what happens. They might surprise us, they might surprise us and actually come in with okay numbers, but any sort of form of miss, I believe, it could be brutal out there, guys. So we'll see what happens, but without doubt, there's There's a lot of fear back in the market. There's a very strange sentiment out there in the stock market at the moment. I mean, I know personally for me, I've been a little bit more negative on the stock market in the last kind of 3 months because of what the Fed have done with the interest rate hikes. But there's a point where I'm looking at it going, I don't know if we should do this though. I don't think we should be having Meta selling off after its best ever earnings, probably in the last kind of 3 or 4 years. Don't think we should have Google selling off after the last 3 or 4 years. I don't think we should have the Russell down for this decade. You know, it's strange. It's strange times out there at the moment, guys. So it's tough. It's tough without a doubt. You know, I thought 2022 was a tough year, but the fact that it seems to be creeping into this year as well, it's a tough time, guys, and it won't last forever. It's got to go back to normal. We've got to have a normal market return at some point. Obviously not now, but it has to. We have to get back to a point where company share prices reflect their earnings and revenue growth. And when that will be, I don't know. But it's got to happen because it's been a very strange 3 or 4 years in the markets for sure anyway. So we'll leave it there. Hit the like button. See you in a bit.